Assalamualaikum warahmatullahi wabarakatuh. May Allah cover you with His blessing, Rahmah and Rahim. This time we meet to talk about the accounting of Murabahah contract. Murabahah contract is a kind of pure sales. This topic is very important as Murabahah is one of the most frequent contracts conducted in Islamic banks. Another reason is that Murabahah contract is credited as one of the financial tools in Islamic banks, while this contract is actually a pure sales contract, buying and selling, or in Arabic called bai. In this section, we will discuss about definition of Murabahah, legal basis of Murabahah, characteristics of Murabahah, and accounting for the buyer as well as the seller. There are actually three kinds of contract in sales transaction or bai in Islamic finance: Murabahah, Salam, and Istisna. Murabahah is a transaction where a seller and buyer agree to the cost and markup of an asset for the sales price. Salam is a transaction where a seller undertakes to supply goods as a future dates in short term, and the payment is in advance. Istisna, the transaction where the seller agreed to construct and deliver asset at a predetermined future time in long term and the price. Therefore, Murabahah can be formally defined as a sales contract where the buyer and seller agree on the markup or profit or a cost plus price for the items being sold. So, Murabahah is a very basic sales transaction, a deferred payment sales to be specific, that can be done in a cash basis or cash sales, or a deferred payment sales or credit sales. Wahbah Zulahaili, one of the famous scholars in Islamic fiqh of Muamalah, defines Murabahah as a sales with a cost plus margin, while OIF, an international standard setter for Islamic financial institutions, defines Murabahah as a true sales-based contract between two contracting parties to acquire an asset, and the cost and markup must be disclosed to the purchaser in the selling price. Then, why it can be a financing tool while this is a pure sales? The answer is because Murabahah can be done with a deferred payment or credit sales. By allowing the deferred payment, bank can then be the seller that provide physical products to the customers as a buyer. However, as this is a true sales, it must comply all the rules for a sales in an Islamic principle. One of them is that the seller should have the asset before it sells it to the buyer. So in Murabahah between bank and customer, the bank should have the asset before they make the Murabahah contract. The legal basis of doing Murabahah contract is stated in Al-Quran, Surah Al-Baqarah, verses 275. Wa ahallallahu al-bay'a wa harrama riba. But Allah has permitted trading and forbidden interest. As a sales transaction, Murabahah should meet these characteristics. It should be a mutual consent. It follows rationality. The object is the commodity, property or tangible asset. The seller should be able to deliver the commodity. The sold item should be owned by the seller. The commodity should be known, and the price should be known also, including the cost and the margin. Here is the scheme of the Murabahah, but let's make it as a Murabahah between the bank as the seller and the customer as the buyer. The first step is the customer comes to the bank and apply for a Murabahah contract. They cannot make the contract straight away. The second, the bank will buy the asset requested from a supplier. The third is, after the bank owns the asset, then the bank and the customer will meet and sign the contract. The last is that the customer take the asset with him and will pay later based on the agreement. However, as banks usually do not will to do such buying assets directly, it's such a bank paradigm that their business is just about money, the bank can ask the customer to buy the asset on behalf of the bank. Bank can have their own warehouse for their stock. Some banks in Middle East area make their own warehouse to put inventory on hand. We can summarize the differences between conventional credit and Murabahah contract. In the conventional credit, the objective for return of the credit is interest, but in Murabahah, the objective is the margin of sales. The object in the conventional credit is money, while in Murabahah, the object is good or service. And in terms of the payable, in conventional credit, the payable increased by the interest, while in Murabahah, the amount of payable is fixed. There are some important rules for accounting in Murabahah. Number 1 is about the initial recognition for inventories and receivable. Inventories recognized at cost or all cost to make the asset ready to sell, and all discounts, rebates, and similar items from the vendor should be deducted from the cost. Discounts belongs essentially to the buyer. Receivable and sales are recognized when the inventory is sold under Murabahah. In other words, if the inventory is received or receivable and the control or ownership is transferred to the buyer. The second is after the initial recognition, if the inventories are not yet sold or transferred to the buyer, the inventories should be recognized in the lower of cost or net realizable value. Number 3 is about profit recognition. Cash Murabahah or short-term Murabahah will recognize the profit at the spot basis. For a deferred payment Murabahah, the profit shall be deferred through a deferred profit account such as deferred Murabahah margin. The deferred profit is disclosed as the contra account of the Murabahah receivables. The deferred profit will recognize every time the buyer do the payment. Down payment is possible and treated as a Hamis Jiddiyah. Hamis Jiddiyah rules that the down payment belongs to the buyer. It is the liability of the seller. The consequence is that if the contract is cancelled after the down payment should be given back to the buyer after deducted with costs that already consumed related to the need of the Murabahah. If the contract goes on, the down payment will be part of the payment of the receivables. For early settlement, the case that the buyer wants to do an early settlement in a deferred payment Murabahah, the discount of settlement is possible. However, it may not be stated or promised from the very beginning of the contract. Then it's about the penalty for a late payment. Penalty is basically forbidden in Islamic Sharia. However, as to prevent moral hazard and to encourage discipline, penalty is then allowed by the country authority. Yet, the seller may not recognize it as part of their revenues. It belongs to the society and should be delivered to the social or charity activities or institution. Here is the report for the Murabahah contract in an Islamic bank. Murabahah will show under the asset as a Murabahah receivable. It also covers the Murabahah income receivables and it should be deducted with the allowance for impairment losses. Here is how income statement appears. In the income statement, we will find the income from sales of the Murabahah appear under the revenues. I hope it gives you a brief review of the accounting for Murabahah contract. May Allah bless us all with the beneficial knowledge and bring maslahah to the society. Have a good day. Assalamualaikum warahmatullahi wabarakatuh.